Michelle Schneider is Chief Strategist at marketgauge.com. Michelle, lovely to see you. Thank you very much for your time. You were listening in to our conversation earlier on with Robert Heller, former governor of the U.S. Federal Reserve, and you had some interesting bits. You had your own interesting take on what he had to say.
Well, I thought a couple of things he said were actually interesting. One was his very Volcker-esque comment about that he would prefer inflation to be at 0%. So I thought that was so far from what the reality is now, considering we've had, 38 months of inflation over 3%. But the other was far more interesting to me. He said at the end of the interview that what would break, when Tanvir asked him that, what would break, that he said that it would be Social Security, Medicare, or pension funds that would not be able to continue to grow or sustain because of the debt to GDP ratio, and that would in turn potentially ruin the dollar as the world's reserve currency. And that my eyes widened, because I've heard a lot of people say that, but I've never heard a former Fed chairman say that. So I thought, wow, that's worst case scenario, but nonetheless, clearly it was right there in his mind as soon as you asked the question.
Yeah, and so how do you tie that in with what the Fed indicated yesterday, what Chairman Powell indicated yesterday?
Well, basically, I think that nothing that he did in terms of his conversation was all that surprising. We all expected the pause to continue, and it has. And clearly, I don't think anything has changed from what we've looked at for quite some time now, which is the decision that he has to make, with clearly things very, very diverse, from some stats pointing possibly to contraction while others point to some areas of growth, while the consumer clearly is feeling pinched right now, and their purchasing power has gone down, which is part of the stagnation. And yet he also knows that if he gets too dovish, inflation, considering it hasn't really come down, and there are still pockets that were much higher than what CPI suggested, insurance being one of them, then he has the risk of goosing inflation even further, in which case then he has to hike. So I don't see anything there that was very decisive. And I don't think he has any reason to be decisive at this point, because he doesn't know. We're in a whole new world.
Yeah, and I suppose, Michelle, the question is, for those out there in the market who are worried that the Fed is late and who are worried about the cracks emerging and the restrictive credit starting to bite when it comes to the consumer, do you think that Powell managed to ease some of those concerns?
No, not really, because I think people are pretty astute at this point, and they're looking at some of these statistics. And yes, CPI looked good on paper, but some of the raises that we've seen still in eating away from home, like I said, in home and in car insurance, in the services area, in home ownership and in renting, these are still really big factors, and people aren't stupid. They know what they're going out and spending money on and what they can afford and what they can't. And of course, nothing was mentioned about oil and energy, but even that's shifting. So that's another thing to keep an eye on as well.
Yeah, after the EIA as well as OPEC's demand projection, that's going to be important. And Michelle, I wish we could carry on this conversation, but it's such a tight day and busy news day that we'll have to let you go at that. Thank you very much. Lovely to have you on the show. Thank you very much for spending the time.